Debtor days is accounts receivable over the total credit sales times the number of days in the period. For example, if your debtors on the year-end accounts is £150,000 and your credit sales in the year, excluding VAT, is £1.8 million, your debtor days are 30.42 days. The accounts receivable represents the total amount of money that your customers owe your business for the products or services that you've delivered but they have not yet paid for. The total credit sales is the total revenue generated from credit sales during a specific period. Credit sales refer to sales where the customers are allowed to pay at a later date, often with payment terms such as 30 days, 60 days, etc. The number of days in the period is the time frame over which you want to calculate the debtor days. It could be a month, a quarter or a year, depending on the reporting period you're interested in. Creditor and stock days has the same calculation as debtor days. For creditor days, it's the accounts payable, otherwise known as trade creditors, over the cost of goods sold times the number of days in the period. Stock days is the average inventory over the cost of goods sold times the number of days in the period. These KPIs are important because debtor days is a financial metric that helps businesses assess how long it takes on average for their customers to pay their outstanding invoices. You want this to be as short as possible. Creditor days help businesses assess how long, on average, they will take to pay their suppliers for the goods or services they have received. Whilst you don't want it to take too long, you also need it to take long enough that you've got healthy cash flow. Stock days assess how long on average inventory is held before being sold. And these are all important measures of a company's efficiency in managing its working capital and cash flow. Thanks for watching.